Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host Daniel, bringing you the highlights and the happenings from around the world. Markets entered 2025 cautiously, with equities posting mixed performances. U.S. indices managed modest gains, bolstered by a Friday rally, while European and Asian markets faced headwinds from inflation concerns and disappointing data. Oil prices surged on supply worries, and bond yields edged lower, providing some relief to fixed-income investors. Let's break it down regionally. The S&P 500 advanced 0.6% for the week, capping a stellar 25% gain for 2024, the best two-year stretch since 1997-1998. The Nasdaq rose 0.7%, fueled by tech's continued dominance. However, early week declines stemmed from profit-taking and weaker economic indicators. The Chicago PMI, a key measure of manufacturing activity in the Chicago region, fell to 36.9 in December, down from 40.2 in November. This sharp decline indicates that the region's manufacturing sector contracted at a faster pace, as readings below 50 denote contraction. The drop underscores the persistent challenges facing the sector, including weak demand and higher costs. The Atlanta Federal Reserve revised its Q4 GDP growth forecast lower from 3.1% to 2.6%, citing a decline in real private domestic investment growth. This downgrade highlights slowing momentum in certain areas of the economy as businesses adjust to higher borrowing costs. Initial jobless claims, a key indicator of labor market health, fell to 201,000 for the week ending December 28th, marking an 8-month low. This suggests continued strength in the labor market, even as other parts of the economy show signs of softening. Yields on U.S. Treasuries declined, with the 10-year yield slipping to 4.60%. as bonds found support amid light economic data and reduced risk sentiment. The Stoxx X 600 gained 0.2%, though major indices like Germany's DAX and France's CAC 40 closed lower, minus 0.02% and minus 0.43% respectively. The UK's FTSE 100 rose 0.91%, aided by a weaker pound that boosted export-heavy companies. Spain's CPI rose to 2.8% in December from 2.4% in November, driven by higher fuel costs. Core inflation also increased to 2.6%, above forecasts of 2.4%. The data highlights persistent price pressures and may delay ECB rate cuts. UK house prices rose 0.7% in December, beating expectations of 0.1% growth. Year-over-year, prices were up 4.7%, the fastest pace since 2022. Meanwhile, mortgage approvals fell to 65,700 in November, below forecasts but still above the 12-month average. This hints at buyer caution amid higher borrowing costs. The Nikkei 225 closed at 39,894.54, its highest year-end level ever, after gaining nearly 20% in 2024. However, the week saw thin trading volumes and profit-taking, with investors monitoring the yen and inflation trends. The manufacturing PMI for December came in at 49.6, slightly higher than the previous month's 49.0, but still in contraction territory, below 50. This reflects continued challenges in the manufacturing sector. although the slower pace of decline may hint at stabilization. The Japanese yen held steady around 157 per dollar, having depreciated by 11% in 2024. Traders are closely watching for signs of intervention from the Bank of Japan, BOJ, as the weaker yen has both supported exporters and raised concerns about inflation. Chinese stocks struggled, with the Shanghai Composite dropping 5.75% and the Hang Seng Index losing 1.4%. Weak manufacturing data and tepid domestic demand weighed on sentiment. December's official manufacturing PMI slipped to 50.1, down from 50.3 in November, signaling that factory activity barely expanded. Similarly, the Caixin manufacturing PMI, which focuses more on smaller private firms, fell to 50.5, from 51.5 the previous month. These figures highlight softening momentum in China's manufacturing sector, despite recent policy support. In the property sector, sales by the top 100 developers remained flat compared to December 2023, reflecting continued weakness. However, a 24.2% month-over-month increase in sales suggests Beijing's rescue measures may be starting to have an impact. A busy week of economic releases will offer crucial insights into inflation trends, consumer sentiment, and central bank policy directions. Here's why these are important. The CPI for December, to be released on Wednesday, is a critical gauge of inflation. The CPI will shape expectations for the Federal Reserve's next moves. A cooling in inflation could bolster hopes for rate cuts later in 2025, while an upside surprise might extend tightening fears. The initial jobless claims, to be released on Thursday, is a key indicator of labor market health. Sustained low claims signal resilience, but an unexpected rise could fuel recession concerns. The University of Michigan Consumer Sentiment, to be released on Friday, provides a snapshot of consumer confidence and inflation expectations. Robust sentiment could indicate strong spending, supporting GDP growth. Reports from JP Morgan Chase, Citigroup, and Wells Fargo will set the tone for Q4 earnings season. Investors will focus on loan growth and credit quality as indicators of economic health, net interest margins in a high-rate environment, guidance for 2025 as a barometer for broader economic trends. Inflation data releases from key economies, including Germany, will influence the ECB's policy outlook. Higher inflation could delay rate cuts, impacting European markets. As services dominate the UK economy, a strong reading of the services PMI could signal resilience, potentially shaping Bank of England policy expectations. Similarly, services PMI data for Japan, to be released today, will provide insight into domestic demand. Any weakness could add pressure on the Bank of Japan to adjust its policies. A vital measure of consumer inflation, Chinese CPI data, to be released on Thursday, will indicate whether China's stimulus efforts are gaining traction. A weak CPI could prompt further easing by the People's Bank of China. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.